these stocks. Well, we are in conversation with Mayuresh Joshi of William O'Neill, India, who looks at fundamental research and he heads research there. Mayuresh, good morning and thanks for joining. I'll start off with the first one, and we have Bajaj Finance. Now, Bajaj Finance has come up with a first quarter update, and things are perhaps improving positively. Do remember, Bajaj Finance at one point in time last month was trading at around 1,700 and 1,800 rupees per share. It yesterday closed about 3,100 rupees a share. And of course, to a certain extent, perhaps the numbers are in there. Deposits have risen 33% year on year for the first quarter. AUM has also gone up 7%. The moratorium amount has come down from 27% back in April to as much as 15.5% at the end of June. And the company has given us some numbers on consolidated liquidity surplus standing at around 17,600 crore rupees. Mayuresh, let me get you in this conversation. Your view on Bajaj Finance, how would you go ahead, considering especially after the kind of strong rally that we've seen in the counter of late?
Morning, Agam. Thanks for having me. No, yes, you're absolutely right. I think the rally was quite stupendous, not just for Bajaj Finance, but for a lot of NBFCs at large. Now, what they have probably disclosed and displayed in their quarterly update, I think the silver lining that a lot of investors on the street are taking is that the moratorium has got reduced to around 15.5% at the end of this quarter from 27%. So that's a huge respite that the street is believing that the worst in terms of moratoriums and the expected provisioning thereof would largely be behind. Now, what has happened in terms of the provisioning it had taken or undertaken in the quarter gone by in Q4 FY20 of 1950 odd crores, 900 odd crores was set aside for the COVID-related stress. Now, they have mentioned that there might be some more that might be required in this quarter, but I think the street has taken that into the stride as well. Yes, you're absolutely right. I think the AUM has grown 7% year on year, but sequentially it has dropped 6%. So from 1.47 odd trillion at 1.38, I think the drop was not as significantly lower as a lot of people on the street were expecting. They did acquire only 0.5 million odd customers, but their database is at 43 odd million, which gives them the ammunition as the recovery starts proceeding far more strongly into the second half to capitalize on this and the digital innovations that they are doing at their end and the cross-selling that is expected, the strong underwriting skills that they have developed over a period of time to keep a control and a tab on asset quality pressures, specifically gross stage 3 reported GNPAs. I think that should very well be kept under control. Deposit growth, as you rightly said, has been quite good as well at 20,000 odd crores, 33% rise. And capital adequacy stays very, very strong at 25 odd percent. So the characteristics in terms of balance sheet strength is there. The expectations in terms of Q1 being extremely soft is getting played out. But I think the street is probably looking in terms of forward numbers and expecting the second half to show significant recovery. From a valuation perspective, again, I think when the stock had corrected at the end of March or April lows, I think it has moved up significantly higher, but it is still trading cheaper if you probably look at the pre-COVID levels or its peak valuations as well. So there is that valuation gap if numbers start coming through in the second half with the quality franchise that it probably has and possesses, that can still get played out. So as per our cancelling methodology, as per our methodology in general in terms of how we rate these stocks, I think it's moving between its key moving averages 50 and 201. So yeah, I think somebody holding on can hold on. The expectations largely, as I said, is based on the premise that second half will be relatively better for Bajaj Finance and most of the quality-led NBFCs.
Okay, fair enough. That's your view coming in on Bajaj Finance. We move on to another company which has come up with a quarterly update, and that's Godrej Consumer Products. Of course, the company has said that on a consolidated level, your absolute sales is marginally lower as compared to the year gone by, but they're expecting a little bit of volumes-driven sales growth. Well, there is a little bit of ambiguity, but it does seem like there is no sharp decline in revenues as a lot of FMCG companies may have expected. But we must also remember that a lot of production had begun earlier on in perhaps the second, third week of May, and that may have perhaps also improved operations as far as some of these companies go. The Godrej Consumer Products specifically in this case also makes a mention of household insecticides, where they have seen a significant recovery. Perhaps it is this segment which has led to not bad a quarter as we may expect. Mayuresh, where do you stand on Godrej Consumer Products in general as compared to perhaps the other FMCG players?
So two aspects again, Agam, right? I think in their quarterly update as well. Again, the COVID-related impact was very well known in the quarter gone by. So in Q4 FY20, they did get a huge hit in terms of both the India business as well as its overseas business as well. In the recent update that they've put through, the household insecticide segment specifically for the Indian market has shown strong underlying demand come through. However, I think if you probably look at their best sellers, specifically in the Indian market, which is hair color and air fresheners, obviously because of the lockdown pressures, you're going to see volume degrowth happening in these two individual segments as well. So again, I think the kind of recovery that you've probably seen, I think that is far more encouraging in the month of June. And thereby, I think they're expecting a close to a mid-single-digit volume growth for the Indian business in general. For Indonesia, which is the biggest market outside India in the Southeast Asian markets, household insecticide sales and the hygiene products saw strong traction. While in the Guam markets, which is the African, the US and the Middle Eastern markets, the sale declines were in the early 20s. Again, this is in perspective of constant currency because you need to adjust that for currency fluctuations as well. But again, I think there is expectations of strong demand expected to come through. So in a nutshell, I think they're saying that on a consolidated basis, they are still expecting sales to be marginally lower in the base quarter in rupee terms as well. Now, what probably has happened for the India business as well, how the soaps growth will be, how the hair color growth will be, and if they are indicating that they're almost 60, 65, 70% in terms of capacity utilizations, I think most of the issues that FMCG players had was in relation with utilization levels not expected to ramp up quite significantly, but most of these players have done a good job. There were supply and logistic related issues as well. So I think most of these issues are being taken care of as well. For the Indian business in general, I think the commodity costs are expected to remain benign. They do have had control in terms of their overall spends. So the marketing spends at around 6% for the quarter gone by should be around the same levels at this point of time. And with their overseas operations expected to ramp up as well, they're probably expected to see volumes also inch up. However, I think what has happened in terms of the price-led volume growth that one sees, how demand catches up for FMCG companies and how the leverage plays out is extremely critical. That depends in terms of the overall reported ROEs. And ROEs for a change of Godrej Consumers has been less than its peers. I think it's hovering close to around 19-20% if I'm not mistaken. Therefore, I think, yes, some positive connotations coming out of the commentary itself, but how does the demand landscape play out, specifically in the Indian and the African and the Latin American or the American context as well, and whether that will have a significant impact in terms of price-led volume growth in recognition of this fact. I think that is something to be seen. Valuation-wise, I think placed reasonably in the mid-range of how it is traded over the last 2 to 3 years. So yeah, I think there might be a positive sentimental uptick compared to what the commentary was.
Okay, and move on to the final stock then, that's PVR. Well, it set its rights issue price at 784. It's planning to raise around 300 crores via the rights issue. The price, of course, is at a 25% discount to yesterday's closing price. And at this point in time, as far as the entitlement is concerned, shareholders are entitled to around 7 shares for 94 shares held. And the record date is July 10th. Of course, Mayuresh, keeping the rights issue aside even, and let's say they do manage to raise around 300 crores, the overall picture for a lot of these broadcasters and exhibitionists isn't the best in this COVID environment. How would you play PVR at this point?
Well, wait and watch, and you're absolutely right. I think movie exhibitors have taken it on the chin because of the lockdowns, and the lockdowns still continuing. There's absolutely no chance in terms of how the earnings recovery will be, and to predict that at least at this point of time. So clearly, if you look at quarter one, because of the lockdown, there is going to be no revenue at all. What has also happened in terms of screen additions, for example, the capex requirements, that will go on the back foot at this point of time. They've obviously had some reworking done in terms of the force majeure clause that they have invoked, and that has ensured or will enable them to reduce the fixed cost rentals at their end. However, I think even if there is a partial reopening that starts coming through over the next few weeks and months, with the social distancing norms, how many people will actually go into the movie theaters to watch movies, assuming all these factors at play? I think that is going to be extremely critical. So I think there is expected to be, because of social distancing and what happens in terms of the seating arrangements, the capacity loss that will come through for these theaters as well, or movie exhibitors as well. The F&B business is also a majority part of the business. So if there are lower footfalls, there will be a lower sale in terms of how the F&B business will play out. And that is one of the biggest gross margin business generators for these movie exhibitors. How the ad revenue plays out, because there will be definite adjustments in terms of people putting in ads and readjusting the rates as well. So clearly, I think there are a lot of factors at play at this point of time. It's clearly a story in terms of discretionary spends, specifically in urban, semi-urban areas. But with all these factors at play, my own sense is that there is a definite earnings hit which is given, not just for the first half, but on an annualized basis as well. How do they manage their balance sheet dynamics and the debt workings at their end, and even the working capital constraints at their end, along with the entire development that takes place in terms of the capacity expansions, which will obviously have to be taken as a back burner and get extended. I think all these factors will play. So again, I think wait and watch for movie exhibitors at this point.
Well, wait and watch for movie exhibitors. But on that note, Mayuresh Joshi, I'd like to thank you for taking the time out and speaking to us here on Bloomberg Quint on those three stocks which are in focus. And on that note, it's a wrap on the segment, but there's lots more lined up. Stay tuned to Bloomberg.